So welcome to the webinar. Again, the title is Back to Basics Investing Like Ben Graham. And in our continued Guru series, we try to feature historic investment gurus, and Ben Graham is obviously at the top of this list as sort of the godfather of value investing. I wanted to just kind of run through the basics for some of you who may not be as familiar with Benjamin Graham, go over his investment philosophy, where he made most of his money, and kind of visit a couple of the scans and screens that we've set up to help identify these types of securities. So really quickly, a disclaimer here, all the information we present is to the best of our knowledge true and accurate. However, if there is a typo or if there's a data issue, please forgive that, and obviously consult your financial professional before investing in any online investment endeavor. So let's look at Benjamin Graham. The handsome devil on the right is him. He is very much considered the father of value investing, born in 1896 in Europe. Came to the U.S. News about one. Grew up relatively poor, but became a great student. Graduated from Columbia University. Was offered a teaching job at the university, but ended up going to Wall Street instead, and eventually started the now famous Graham-Newman Partnership. He is the author of two best-selling books. 1934 saw the release of Security Analysis, and then The Intelligent Investor later in the 40s or 50s. And The Intelligent Investor, if you have not read it, it is often referred to as a Bible of value investing. It's a big book. We're talking about 500 pages or so there. But if you are looking for something to read, that is really kind of the definitive place to start. Now, many of his disciples are now famous. His most famous student, Warren Buffett. Others include Charlie Munger, Phil Fisher, Walter Schloss, Peter Lynch, and John Templeton. Manish Pabri also followed his teachings, although not direct students of his, Whitney Tilson, Prem Watson, a handful of others. So he's probably been the biggest influence to hedge fund and mutual fund investors today, and we'll show you why. And really, he's just kind of the first person to put some common sense to the investment world and really define the difference between investing and speculation. So his investment philosophy is fairly straightforward. I mean, practice safety and preservation of capital over everything else. Really specialized in net investments. And if you're not familiar with what nets are, Peter Lynch referred to these as asset plays, but in a very simplistic explanation is it's when the company is worth more shut down today than it's currently trading for. Okay, so he'd look for stocks trading at a discount to net working capital, and he was able to find a lot of these in his day. They're much fewer and far between today. But an example would be if a company has, say $1 million in cash on the books. They've got another $500,000 in stocks, and so they've got no other real network, but they've got net current assets of maybe 1.5 million, and they have no debt. So the stock of the company should be worth $1.5 million. Just if you shut it down and took the cash and sold everything off. But meanwhile, the market cap of the company might be something like 700,000. Okay, so he's able to buy a company that on paper with no earnings is worth this, and you get it at a discount, so net, or a net discount to net working capital. And the only risks are if you find companies that are losing large amounts of money, if they're hemorrhaging cash, your net income is very negative, it's going to eat into that margin of safety of the net working capital. But he's able to find a lot of these in companies that had more money in cash than the stock price was trading at, and no noticeable debts. We just bought baskets of these and made really good money. And again, he generally bought companies trading at less than 2/3 working capital. So these are tougher to find today, but he went a lot further in his stock analysis and showed us more about how to value companies from a strategic standpoint. That's really what we're going to cover. His main rule of thumb, if you had to put hard numbers to it, was he looked for stocks trading at less than 15 times earnings and less than 1.5 times book. We lost our audio connection for a moment there. But anyway, bought companies trading at 2/3 working capital. His general rule of thumb, if we had to put numbers on it, was he's looking at stocks trading at less than 15 times earnings and 1.5 times book value. Now, these are harder and harder to find today, especially a combination of the both. Stocks are more richly valued. Now, a few things to take in this. We got to remember the context from Graham's time when he was looking at this. Okay, there was no technology stocks. There was no internet. The majority of the big blue chips were railroad companies and defense firms and utilities and companies that just were not capable of growing at the same rate and required a lot of assets to do business. Okay, they had to have these huge book values here in order to operate because they were very capital intensive businesses. We're looking at the steel industry and the automotive industry and these large enterprises. There was no Facebook where you could take a $100,000 investment and turn it into a multi-billion-dollar conglomerate. It just wasn't possible in those economies of scale. So book values are a little bit higher. The exception is really financial companies. Financials you want to value more from the book value standpoint. You can find a lot of good financials that meet these criteria. But if you're looking at large staple firms that you want to buy at 15 times earnings and 1.5 times book, they're just becoming more difficult. Now in times of turmoil, we do another 2008, 2009 debacle, you can kind of have your way at these multiples. So he kind of put a variance in there and said, look, if you pay less than 15 times earnings, you can pay a slightly higher book value. Or if you pay slightly less than 1.5 times book, you can pay a slightly higher earnings multiple. So 15 times 1.5 is 22.5. So his rule was the combination of the PE times the price to book should be no more than 22.5. All right, so that's where the Graham number comes from. And on our website, you'll see the Graham number is one of our valuation principles. And it's going to throw some square roots in there, but what it is, it just takes earnings per share and tangible book value per share, multiplies it by 22.5, and then finds the square root of that. And what that gives you is the max price that Graham would pay on the equivalent of 15 times earnings per share and 1.5 times book value. Okay, as long as this combination is 22.5. So it could be 20 times earnings and whatever it is, like 1.1 times book value, or it could be 2 times book value and 11 times earnings. However that combination strikes out to be, the multiple of 22.5 sort of serves that purpose. And when we look at the Graham number, we see for pretty much any stock it's going to come up. So let's look at Bed Bath & Beyond. It's been a stock I've been talking about a lot recently. If we take a look at this stock, one of the valuation metrics up here in the top of your screen among the others is the Graham value, and that's what this number is. It's a combination of earnings multiple and price to book, the equivalent of that 22.5. We see that number comes in at $41 a share. We're trading slightly over that. Now you can also see it in the 10-year financials. When you scroll down to the bottom of the page, these may be cut off for free members, but premium members get access to all the valuation ratios and the historical valuation and quality, and one of these is the Graham number. It's about 6 up from the bottom, and this is it right there on a per share basis, and it's showing you where it's been historically going back. So again, a lot of the multiples are higher today, but you will find some quality companies that meet this criteria. When you do so, it's a pretty solid valuation standpoint. Now, he gave us some other formulas in his book. In the 1962 edition of Security Analysis, he gave a formula for intrinsic value. Now, he gave a lot of caution and warning when he gave this, in saying that don't use this to try to determine the exact dollar, to the penny value of what a stock is worth. Essentially, you're just trying to get a ballpark figure for what that value is and know if you have a large margin of safety or a large discount between the current price and what you estimate the value to be. And this is it. So we looked at earnings per share times 8.5 because he believed that to be a fair PE ratio for a non-growing company. And again, it's tougher to find today, but that's really what it should be worth if it's a non-grower. And then added twice the growth rate. Okay, so if we get a company that's earning $1 per share and it's not growing, we should buy it about $8.50. If it is growing, let's say, and again, this growth rate is what he's looking for is a reasonable expectation for the next 7 to 10 years. Okay, so if a company went up 20%, grew EBITDA 20% last year, unless you expect them to continue that pace for the next decade, don't use it. So he's a big conservative guy in that sense. So if we say it's going to grow 5%, then we get a stock. This is 10 plus 8. It's going to be 18 times the 1. So we'll get a value of around $18 a share. All right, so this isn't, this is in contrast to saying you can only pay 15 times earnings. This is the equivalent of paying 18 times earnings, but it's a 5% grower. Now, if it were a 10% grower, this would go up substantially to $28 a share. And you wouldn't think of Graham paying 28 times earnings for a stock, but it's all based on what that growth rate is. And it's, again, he put a lot of emphasis on a rate that you can reasonably expect for the next 7 to 10 years. So, we do a lot of stuff. We look at, well, whatever it grew the last 10 years, we'll assume it's going to do the next 10 years going forward. And you really want to use a lot of caution in doing that because all companies start out as fast growers. They all eventually slow down. They all eventually become stalwarts because they just can't maintain that growth rate. Apple is a wonderful example of this. You look at a company that's growing 20, 30, 40% a year. It's just not fathomable for a $400 billion company to continue growing at 20% a year, and they're not going to. I mean, if the absolute top end of expectations for the iWatch and the iPhone 6 and new iPads, I mean, maybe they'll get there for one of those years, but it's not going to happen for an entire decade. So always use caution with that. All right, it's a pretty good formula. So if you want to write this down again, earnings per share times 8.5 plus 2 times the expected 7 to 10 year growth rate. Okay. Now, he updated this formula in 1974, and 14 years later he released a writing entitled The Decade 65 to 74, Its Significance for Financial Analysts. And it's the same formula as before with 2 additions. And those additions are this 4.4 and the Y. And the 4.4 was at the time the average yield on high-grade corporate bonds, and Y is the current yield on corporate bonds. So what does this really do to the formula? Well, all it does is add in the effect of current interest rates. Okay, so if the current yield on bonds is lower than average, it's going to increase the fair price for that stock. If the current yield is higher than average, it's going to lower the fair value of that stock. And this really makes sense if you think about it. Buffett's been quoted many times talking about interest rates and referring to something we know as the capital market line. Okay, and if you're not familiar with this, it's just something that looks like this, and all it says is if 5-year government treasuries are paying 2%, are yielding 2%, then AAA corporate bonds are going to need to yield higher since there's more risk. Maybe those demand 4%. So corporate, junk bonds may need to yield, 7 or 8% in order to entice investors. And then if you're going to invest in stocks, maybe those need to yield maybe 8% on earnings or something similar because there's much more risk in equity than in debt. And if you're going to invest in really speculative stuff, maybe it needs to show something like a 12% yield. It's just a basic capital market line showing that with the additional risk, investors demand a higher perceived return, right? It's not news to us. And so when you can get 10% on a government bond, do you have any interest in buying stocks that have an earnings yield of 4 or 5%? Absolutely not. because you can get a higher return with no risk, well, essentially no risk from government paper. So that's one of the reasons why stocks are much more richly valued today, is because we've seen interest rates in a historic decline and now sitting at near all-time lows. And we'll look at a chart of this in the interactive charts. Let's see, economic indicators. And this is one of the cool features of GuruFocus. It's got these really fantastic fundamental charts. And if we look at 10-year Treasury rate, the constant maturity, and this goes all the way back to 1960, but look at the decline we've been in since about 1980. I mean, there was a time, if you weren't investing, you could get 15% on 10-year Treasury notes, and now we're getting 2.5. We saw as low as 1.8 or so about a year ago, and so by no surprise, we've seen the S&P do this and climb to spectacular heights during the same period. Because as the yield you can achieve from government paper shrinks, the necessary risk premium lowers, and that pushes stock prices higher. Let me see if I can find the S&P. Okay, so here's the PE ratio of the S&P 500. And if we look at just the last 20 years or so, I mean, there was this spike in 2008 when they weren't earning much, but you see definitely an increase here when the PE ratio used to be 14, 15, and got a little high in the 20s. Now it's down to 14. It's averaged somewhere around 15, and now we're pretty consistently staying higher than that. So it's just another way to look at the data, but essentially all this addition is saying is when yields are relatively low, stock prices are going to be higher, and that's the environment we're in now. So if you want to refresh his formula, just look at the 10-year, the average on high-grade corporate bonds today, substitute that, and then put the current yield on AAA corporates in there, and that's going to adjust that formula for you. So let's look at the screeners. I want to show you some of the tools we've designed, that Charlie's designed to really capitalize on this Benjamin Graham approach. And we have a handful of value screens designed to mimic some of the best investors out there. Also, these model portfolios, which are fantastic if you haven't seen them. Looking at relatively, we got a Buffett Munger screener, undervalued predictable stocks, historically low price to sales and price to book, and we're consistently outperforming the index with these. I mean, all four of these have outperformed the S&P by a respectable margin since their inception. Most have done so in each of the last 4 to 5 years. 2011 was really the one exception where they kind of lagged a little bit when the market was flat that year. But for the most part, they're outperforming. And one of the ones we've got here is a Ben Graham net screener. Now, we talked earlier about Graham and his preference for nets, and it was a land of opportunity in the 30s and 40s. He found tons of these and just filled his portfolio with baskets of them. They're harder to find today, and the ones that are going to show up here generally are pretty small companies. If we look at the market caps down the right side of the screen, most of these are micro or small cap stocks. I mean, 3 million, 8 million, 40 million, some as low as 1 million or less. Very few of these $300 and $400 million companies. But what this is looking to do is identify companies trading at a discount to their net current asset value. And a quote from Graham here in his book said, "The idea here was to acquire as many issues as possible at a cost for each of less than their book value in terms of net current assets alone, i.e. giving no value to the plant account and other assets. The purchases were made typically at 2/3 or less of such stripped down asset value, and in most years we carry a wide diversification here, at least 100 different issues." So you'd be hard pressed to find 100 of these today, but this is the strategy he approached. And the formula using here, net current asset value, is simply the current assets. So it's cash, marketable securities, accounts receivable. It's not taking into account property, plant, and equipment. It's not taking into account the intangibles or forward tax credits, anything like that, and then subtracting all the liabilities, so every dollar it owes. So it's saying if you took just what you have that's liquid, paid off your debts, you can get it at a discount to that. All right. That's net current asset value. Net working capital is very similar, but it takes into account all the assets and just puts some pretty aggressive discounts on them. So it discounts accounts receivable. It gives you credit for 75% of those, meaning it puts in a 25% margin of safety against the potential for unpaid accounts, and then discounts inventories by half. So it says whatever you're holding, we're going to say at fire sale prices, we're only going to give you credit for half that. And it just puts in additional safety because you're lowering your valuation to account for the fact that you could have some miscalculations or you could be wrong, you'd still be in a very safe situation. So these are the stocks it finds, and like all of our filters and screeners, you can use it not only for the U.S. but international markets as well. If you're looking for Canadian stocks trading at net, you can do that. You can certainly see a lot of these in Asia and Europe. We'll focus on the U.S. for the time being, and it'll populate a list of these securities. Now, a lot of this stuff is going to be junk, okay? It's just par for the course with this type of investing. When you're looking at stocks trading at less than the cash they have on hand, 99 out of 100 times there are some severe problems on hand. Now I'll give you a couple examples. One I think was good, and one that I'll show you to avoid. And there's two stocks I want to look at are Emerson Radio and Gravity Company. Now Emerson is one I invested in personally back last year, and I'll show you why. It's pretty safe, and it's actually still an opportunity today, I think, as the prices come down. But all you're looking at here is the balance sheet to find out if you have an opportunity. Okay. Now, what you want to note right offhand is what is the market cap of this stock. Okay, so the market cap is just a share price times number of outstanding shares. So it's the price to buy the whole company. All right. So instead of getting it all down to a per share basis, we're just going to look at the whole company as if we're buying the whole thing. So we got $47 million is the price to buy it today at $1.75 a share. So as we look at their balance sheet, we just see what they're holding should we shut things down today. All right, and trying to fit the whole balance sheet in, can't quite do it, but here's the balance sheet. So we're looking at cash and marketable securities, which is just stocks and things. So this is their liquid assets they could convert immediately. It's about $55 million today, $56 million. All right. They've also got, and I'm just going to try to show you which highlight what we're focusing on to keep your attention in the right areas. We're just looking at the most recent numbers. Accounts receivable of $12 million. As we saw, we discount that by 25%, so knock that down to maybe 9. Inventories we discount by half, so we'd take $3 million off of that. So we're taking about $6 million off the assets, which brings this 80 down to about 75. 80.6 must be about 75. And then we're looking at their total liabilities, every dollar they owe, which at this point is $6.2 million. So 75 minus 6.2, I know, very complicated math, right? Means this company is worth, on paper, about, $68 million. Okay, it's just their balance sheet, discounted book value, what they're worth. If you shut it down, took the cash, took the stock, sold off the equipment, that's what you got, $68 million. All right. Now, their book value or total equity is $74 million. But, we applied those discounts to get that 68. All right. So what you're getting is $68 million for $47 million. This is a pretty good deal, right? I mean, if I offered you a bag with $68 in it and said I'll sell it to you for $47, you'd jump all over it. So, we've definitely got a clear margin of safety in there of somewhere around 35–40%. Okay. The next thing you'd want to look at is what are our risks? All right, if we're buying something worth 66 for 47, what are the risks? Well, if our numbers are correct, the only risk is the 66 isn't really worth 66. So what could cut into that? Well, if they're burning through money, if they're burning through that book value we're trying to find. So to determine that, you're just going to look at their income statement and see what they're working with. I mean, they're bringing, obviously their revenues are shrinking, as we're seeing here, but they've been able, for the most part, to keep net income positive. Now, they did lose $1 million over the trailing 12 months, but it's not a huge significant number. What you want to avoid is when you see this is all red, or if they're losing, $20 million a year, then that $20 million premium we're trying to capture is going to disappear pretty quickly. All right, so you want to go, but it's not losing cash. Now, Emerson is shown to be fairly nimble in the fact that they've seen revenue shrink from 200 million to 86, but their SG&A expenses are shrinking along with it, and their EBITDA has actually held up pretty decently considering. So it's not a company that has such huge, large fixed assets and fixed expenses and liabilities that when the revenue shrinks, all of a sudden you're seeing, huge red losses down here. But this was the case for me when I did this last year, and I'll show you the stock charts to give you an idea. By my math, I did it down divided by the number of shares and found the thing to be worth at the time around $2.40 a share. Was able to buy it in the $1.50 to $1.55 range back here. So I bought some here early, and I bought more when I dipped back in there because I was looking for 50% upside, and then just put in a sell limit order at $2.25. Now, use $2.25. You don't want to be too stingy with these. If it's worth $6 a share, generally you want to use about 90% of that value doing these net nets. Okay, there's always going to be a little bit of a discount applied to it because it's not a great company. So, if it's worth $10 a share, try to sell it at 9. This I thought was worth $2.40, so 10% of that value is about a quarter. Applying a 10% discount to that, so 90% of this came out to around $2.20 or $2, really $2.15. I guess I was being stingy at $2.25. But just put the limit order in there. Didn't have to do much. Just sat around and waited on it, and the thing really went to sleep for quite a while. Take a little pop, went to sleep again, and then finally just hit that value number. And so this is how it often happens with these small cap stocks. Is they just seem to move. I mean, there's almost no news to push these things, but it's such a small company, it's so thinly traded that, one investor with a little bit of weight going into the market order can move these things pretty significantly, and that's generally what we're seeing in these areas here. So the thing continues to fall. Again, if you can get the same discount, it might be not a bad place to go. But let's look at the other side of the coin. Let's look at one that at first appears to be a good discount, but then we see maybe it's not. All right, so this is Gravity. This is a company, let's see, they develop online games in Japan, Taiwan, Brazil, Philippines, Thailand. It's really a gaming company. But once again, we're going to go straight to the balance sheet. We immediately see it's trading at 40% of book, which appears to be just a huge, huge discount. Almost all our valuation metrics here, it's in excess of. So let's take a look at what it's doing. Now we go to the balance sheet. Once again, we're going to do a very grade school analysis of this company as of the most recent. And let me highlight these figures really quickly so we can identify them. As of the most recent quarter, here are the figures. We've got $31 million in cash, or 13 million securities, for a total of $45 million in liquid assets. Accounts receivable, we'll discount that a little bit. Intangible assets, we'll scratch those off completely, so that's $12 million off the board. So we'll take about 13 million or so off this figure, if that sounds right. And so our 80 becomes about $67 million. All right. Now we're going to subtract the total liabilities. Never any need to adjust these because what they owe is what they owe. They're never going to undershoot it or overshoot this. If we subtract that 17 million from the figure, we get a pretty conservative $50 million discounted book value, right? And if you shut the doors, fired the employees, sold the businesses, took the cash, cashed the stocks, you get about $50 million with this thing, okay? Now, once again, the book value it's quoting is 78 million, but that includes the intangibles. It includes full figure. Excuse me, 63 million includes figures. But we're at 50, right? We're trying to be as conservative as possible. We want to have numbers that reflect the maximum margin. Say it's working $50 million. Meanwhile, we can buy this stock for 23.9 million. All right, so that should be a 100% upside all day long. And if you could buy the whole company outright, it would be. But here's where we run into a problem. This is why you want to look at the income statement. Once you determine you've got a value is, look at all that red on their income statement. Primarily their net, they're just hemorrhaging cash. They had a kind of a flat little decent run from 9 to 11, but they're back losing money again. 11 million, 17 million, 18 million. All right, so if we're buying a company at 24, trying to get the 50 out of it, we're trying to capitalize on the $26 million price adjustment, right? And really, if we apply a discount of this, it becomes 45. So we're looking to try to make around the $21 million if we buy the whole thing, right? But they're losing almost that each year. So if we hold the thing for 12 months, they burn through another $20 million, we no longer have an opportunity. If they burn through 20 million of our cash, this comes down to $25 million, and our $24 million market, buying price is no longer a good deal. So that it's pretty simple, and this can be a lot of fun. It's the easiest way to invest if you find good opportunities, because you literally just purchase it, put a limit order to sell. If it keeps dropping, you buy more, and you just keep an eye on the big picture of this company. Check their quarterly filings, make sure they didn't just throw away a bunch of money or do something crazy. And then the final thing to look at is insider ownership. What you want is a high number of insiders holding the stock. You want the company CEO and the CFO and the head of marketing. You want all these guys to be holding the same bag you are. You want them to be holding the stock so that their interests are perfectly aligned with yours. And if you click on the short interest heading on any stock on Guru Focus, we give you this figure. And in Gravity's case, it's an abysmal 0%. Now, if this were a $50 billion company, it'd be understandable because their ownership is very small. But we're only talking about a $24 million company. 1% of that is only 240 grand. So between all the people that work there, combined, they're not willing to risk $200,000 on their own stock. So that's generally a pretty bad sign, and we can see why. If we switch to the one we just looked at a moment ago of Emerson Radio, we see that they actually hold some of this stock. And I'm surprised it's this low. It used to be... Okay, they must have recently sold some. It used to be much higher. I mean, it was 5, 6%, 40, and this could be bad data. But generally what you'll see, if it's a good opportunity, the employees recognize the same thing, the executives recognize the same thing, and they're picking up stock along with you. And then the really final thing to look out for when you're doing these nets is dilution. And most of you are familiar with this term. Dilution simply means they are diluting your shares. They're issuing more and more stock, making the percentage you own worth less. Okay, so if you used to own 1% of the company, now you own 0.5% because they dump more shares out there. So to define this pretty easy. Just go to the bottom of the income statement and see shares outstanding. If this number here is increasing, they're issuing more stock or giving it in stock option bonus awards. However, if that number is increasing, your stock is becoming worth less and less over time. If it's decreasing, you've got a concentration going on. They're likely doing buybacks, which is very much a positive symbol. But it really doesn't need to be much more complex than that when you're doing the Ben Graham net approach, okay? And these are all stocks. A lot of them are small and micro-cap companies. A lot of them are going to be garbage, but you could find some great opportunities in this list. And this is the same list I found Emerson Radio from, and I made a nice little 50% upside over the course of about 8 months without any work on my part other than just sitting around waiting for my limit order to be struck. All right, Solutron Devices is another one we've seen before, or I've seen before. It's a stock that's been hammered pretty tough recently. Oh, I'm sorry, it's been has not been here. Where's the pullback? I thought this one just took a dip. I guess not. But when we look at their financials, we see it's trading at 80% of book value. But this is a very different picture because there's very little cash. There is some stocks, about $6.25 million, so around $7 million in liquid assets. Total inventory is about $4.5 million. Remember, we cut that in half. We discount that by 50%. So let's do this one really quickly. We'll take a look. We've got. We're going to take $2 million off for this figure. Property, plant, and equipment is very, very minimal. So we're looking at ballpark around $10 million, right? $10 million in assets minus their total liabilities of only $1 million. So we got about a $9 million company here on paper. And what is the thing trading for? $9 million. So showing a discount to book, but really we're getting it at about book value now. So the beauty of these when you get a low book is if they're earning money, which this one is, you're essentially getting all the operations for free, right? I mean, the share price you pay is completely backed by cash and securities and a little bit of inventory and what they've got there. So if it turns out they start making a couple bucks a share, that's all free to you. And this is a company that, although very small, has maintained positive net income each year. And even at just 90 cents a share, that's only about 10 times earnings. So this is one I think is very much undervalued by Graham's figures, right? PE of 11, price to book of 0.8, really priced it to tangible book of about 1. But it definitely meets the Graham number, and it's well below that. So I don't know a ton about this company. It's over the counter. It trades on the pink sheets. It's very thin. But if it turns out to be a solid company with a quality product that you believe has staying power, these are the kind of stocks that Graham would be buying. The difference is the Solitron devices of Graham's day were like, you know, Bell and, you know, railroad companies and large firms that he could buy at that kind of a rate. For us, if you're going to be a net guy, you've really got to dig through the penny stocks and the small caps and the ADRs and a lot of these smaller firms that a lot of people are not attracted to. But if you're very much the research-focused type and you like to dig in, I mean, you're not going to find these stocks blasted across the Wall Street Journal. Not many people are writing about them. When you find them, they're so small and they're so unnoticed that once a couple of people find it, that have deep enough pockets, the value will be realized. So that's the net Ben Graham screener. We can also use the all-in-one screener to try to find stocks that meet the Graham number. All right, so if we want to find larger companies, we'll go ahead and get rid of these over-the-counter stocks. And we can go to, let's see, is it valuation? Where's the Graham number? Yeah, we've got right here, it says price over Graham number. So what that's going to give you is, if the price is greater than the Graham number, it's going to be over 1. If it's less than the Graham number, it's going to be less than 1. So if you want to find stocks at a discount, you just want them trading at a value less than 1. Okay, you want them lower than their Graham number. And you can put some more metrics in here to try to filter this list down further. If we want them less than tangible book, that's going to cut our list down, it looks like, about in half. If we want a profitable company, let's see, we can just do net margins. We want a positive net margin, meaning they're earning money, and we want them to be earning money, the 10-year average, so they continuously earned money. We can look at a PE ratio of if we do at least one, find companies that are actually earning money. And we can even try to filter this down further looking for growth. We can, if you don't want to find the really tiny company, you can say, hey, we want a market cap of at least, $50 million or $100 million, whatever that threshold for you is. If you want to remove certain industries, like we can take the financials out of here that tend to have more inflated balance sheets. So if we remove all the financial services, that cuts our list down pretty substantially. And now we've got about 67 companies that are probably worth looking into. We've got some airlines, retailers, real estate, consumer electronics, an ag company, packaged foods. A lot of companies in here now that are trading at discounts to this Graham number. So another way to start. I mean, the beauty of this screener, again, I think it's the best fundamental stock screener available anywhere on the market. You can look through essentially anything. And this is a nice way to just start with the Graham number, filter down a little bit further, and create a list of securities you're willing to dig into. But with any net, I encourage you, don't just run a scan and buy the entire basket. You always want to take the 5 minutes we did to look through the company's financials and just look for red flags. Are they losing a bunch of money? Is their assets, is it intangible or all inventory, or something that's not really worth what they say it is? Are they issuing stock and diluting shareholders? These are all things we want to be aware of and avoid in order to capitalize on these. But a lot of people made a good living doing this, and Walter Schloss is one of them. He's one of the guys Buffett called a super investor. We did a webinar on him. If you want to go back and look at the archive, all he did was buy low price to book stocks. That's all he did, and he's got a 50-year track record that is phenomenal. It was literally him and his son in a one-room office managing a limited partnership for decades. And this is all he did, was look through and try to find stocks meeting a similar approach. He's very much a student of Graham. And he bought everything based on the balance sheet. He checked the income statement just to make sure they weren't losing money, but bought it all based on the balance sheet. And the beauty of that is the balance sheet figures don't change very much, right? I mean, you don't have to really try to project where things are going to be. And when you're getting them at very low price to book multiples, generally these figures aren't fantastic. Maybe they're just breaking even. And if they turn their business around, start earning some money, you could have a really substantial upside on your hands because you got it at book, and now all of a sudden there's earnings to go with it. Now the other side is possible as well, which is why I want to look at the history of their revenues and their income and everything they're putting down. So let me answer some of your questions here. Just realized we got a bunch of them. Lola, yes, it is being recorded. It's available on the homepage. What term bonds are we looking at? Norman, so when you're looking at that previous ratio, corporate bonds, generally looking at 10-year bonds. Sal, insider ownership data is coming directly from Morningstar. Mike, when a stock goes up more than 50% in the range of 6 to 9 months, do you sell or wait 1 year to take advantage of tax? So very good question, Mike. And what he's asking is, if you bought a stock like this, say Emerson, we think is worth, $2 1/4. You bought it at $1.75. It runs up. You're up 40-50% in a few months. Do you sell it or do you hold on to it to try to only have to pay long-term capital gains tax? Mike, my advice, would be just not let taxes play too big of a role. I mean, if it happens on the 11.5 months, and you can hold it for 3 more weeks and capitalize, that's one thing. But generally, you figure what it's worth, you put a limit order in, and you take it when it hits there. And Emerson is really a great example of that. I couldn't have been happier to have sold this stock at $2 1/4 because it's since fallen back. And they're just really volatile and really unpredictable when it comes to these small penny stocks. And when you get this opportunity, you just got to take it. Vanu, high net current asset value is nothing but cash minus long-term outstandings plus half receivable. That's correct, yeah, Vanu. And I'm just looking at some of these from a very basic point of view, but you can do net current asset value or just net cash. High current ratio is another way to do it. It's not going to find the same thing, though. Roger, what about free cash flow? So free cash flow, Roger, is another metric you can look at. Again, there's really no right or wrong answer when it comes to investment analysis. If you tend to favor free cash flow over net income, that's fine. I know the street tends to follow net more. Value investors tend to follow free cash flow more. We've actually done some studies that surprisingly showed free cash flow is one of the least correlated fundamental indicators for stock performance. So it's disheartening, especially since it's been taught so much by Buffett and others to watch free cash flow. And free cash flow may prove out to be the best if you're trying to find, a handful of fantastic companies you can own for 10 or 20 years like Buffett is. When we're just looking at a quick and dirty analysis, I'll generally favor the net. Mike, how would you size your portfolio with a screener, such as 20 stocks, 5% each? Yeah, it really depends, Mike. I mean, generally what I'll do, and there's no right or wrong answer here, but what I'll do is kind of split a portfolio up, right? So if I've got, I'm in my 30s, so I'm a little bit younger, but I'll kind of break it into 4 sectors. I'll do, if I can find like these nets, if I can fill 25% of my portfolio with these types of stocks, I'll do it. I'll look for the very stable, stalwart type companies trading at a discount. The more boring ones we can get, very deep, traditional value stuff here. Growth making up another quarter. If we can get our hands on Googles or 3D printers and those kind of stocks at relative cheap values compared to their growth, I'll put that in there, and then have 25% that in today's market is more cash based, just because of the valuation levels. But you can take this and just put it in an index ETF if it's undervalued. You can do more speculative stuff with it, or you can put it towards, if you find more nets, or you find more value, you find more growth, kind of allocated accordingly. But I mean, I wouldn't say put 100% of everything you own in one of these types of stocks, because these anomalies do happen. And even Graham, who was a genius, and Schloss, who was fantastic at this, all of them believed in owning 50, 100, even more stocks in these types of categories. It just depends on how many you can find. But I mean, with that being said, I went pretty heavy with Emerson Radio. I mean, I think I was up to 15 or 20% of my portfolio at one point, just because it was just a no-brainer. Any other questions concerning the Graham screener? Vanu asking how to avoid value traps. Vanu, the biggest thing, like I said, with value traps for these is just watching the income statement or watching the cash flow statement. Okay, the biggest things to avoid, if most of their assets are inventories, be very, very careful of that. You need to know what those inventories are really worth at fire sale prices. If it's a computer company, they're going to be declining at a very fast rate. If it's steel or a commodity, it's open to the fluctuations of those commodity markets. The other thing is, are they hemorrhaging cash? I mean, if they're not burning through money, they can't really spend that book value you're getting. They could always surprise you and just come out and lose money, which no one saw coming. That could happen with anything. But just make sure they're not losing money. Make sure their assets are as liquid as possible. I mean, the more cash and marketable securities you can get, the better. That's really about it with value traps in this net sense with the asset plays. But good question. Any other questions? What is the subscription cost? Vanu, so the subscription cost, this is for all of our website is one price, right? I mean, this screen, the Peter Lynch screen, the net Graham stuff, all we have other than the Peter Lynch newsletter, which is a premium product, is available at one price. At current, it is $349 per year. You get, the real-time Guru picks. You get the updated quarterly filings of everything they're holding and what amount. Our full screeners, the value strategies I covered very briefly, insider and Guru buys, the valuations, the analysis, a couple of free months newsletters to put out there. This site has hours and hours of exploration built into it just to uncover all the tools we're giving you. But we always do it with a 7-day free trial, okay? Because we want you to try it out. We want you to see all that it's capable of and the full power of the website. Decide if it's for you. If it's not, hey, cancel, you can call us, email us, do it on the website. No questions asked. Won't be charged a dime. We even added a 30-day money-back guarantee. So if you're outside your trial window, it's been 2 weeks, you change your mind, we can still refund you inside of 30 days. You really have no risk with this. We do it simply because we know the value of our product. We want you to put it through its paces and try it out, and we're very confident that you're not going to be able to live without it once you've used it. Now, we also have global membership. I mentioned some of the other regions. All the tools we have can be applied to global regions. And these are available as add-ons depending on the size of the region, the number of stocks covered there. But Canada, the UK, and Ireland, Europe, Asia, Oceania, which is Australia and New Zealand there, all can be added on to this membership. And like the regular membership, if you're already a premium member, you can tack one of these on, the same deal, same free day trial. If you decide in a month you want to swap Europe for Asia, you can do it. If you decide you want to cancel it and get prorated back, you can do it. We're not going to overbill you on this. We're not going to lock you into these contracts. So you have a lot of freedom and flexibility to move back and forth between these. But the full Guru Focus site, Venu, to answer your question, is $349 per year. Well, thank you, Mike. We appreciate that. Michael, any geographic markets you can cover, you find an abnormally high number of nets. Yeah, let me take a look at that. How frequent is dated? John, how frequent is data is updated in real time? So if a company files, if Apple comes out and reports their numbers, once it's reported to the SEC, it's on our site inside of 20 minutes. All those screens, like the Ben Graham net screen we were looking at, those are real-time updated. So the list, it's done automatically based on the fundamental data. So if a new stock based on its price movement or new financials puts it in or out of the list, it's updated on a daily basis. So you've always got fresh stocks to look at, and that goes for all of these lists. It goes for our low price to book companies. It goes for our low price to sales. This is probably one of my favorite screens, the low historical price to book, because what it does is not just find stocks at a low price to book, so say less than 1 or less than 1.5, but it finds stocks trading at low price to books relative to their 10-year history. So if Walmart generally trades between 3 and 4 times book value, that's a deal when it trades at 3 times book. But if Wells Fargo normally trades between 1 and 2 times book, it's only a deal when its price to book is down to 1 or less. Okay, so it finds really high quality, very predictable companies trading on the low end of their 10-year median range. And the performance this one's been, I think, one of our best. If we look at this thing, let's see. Yeah, it's outperformed the market by the widest margin. And it's even up 11.5% this year, and the market's done about 5%. So it's really, really strong, and it's all based on these same Graham principles. Just another way to look at the data. It's further filtering down to really high quality companies, and it's not looking for nets. It's just looking for ones that are relatively cheap in regard to book value. Venu, altogether global, you get like $100 off. You add all the regions, but it just depends on which ones you want to add. Norman, are filings outside of the U.S., Charlie, updated as quickly? Okay, for Canada it's about 24 hours. UK is about 48 hours. Yeah, most of Europe. So yeah, it's not quite as quick, but it's not like it's done manually and we'll forget to do it. I mean, it's generally done within 24, 48 hours. So good question, Norman. Any other questions regarding either membership or the Ben Graham screener? Otherwise, I'll let you guys continue the rest of your day. Alias, we do not include the Mexican market at this time. All right, well, I'd like to thank all of you for attending today. Thank you so much for joining us this Wednesday afternoon. I know you have a lot you could have done. We do appreciate you spending it with us. If you have any other questions, if you have a request for website features, definitely feel free to reach out to us, support@gurufocus.com. We'll be sure to get back to you. I encourage all of you, if you have not, to sign up for the trial, put the site through its paces, put all these tools to work in your portfolio, and you'll begin to see the value of this. If you want to learn more about what we offer, again, just go up to the home page, click on tutorials. We've got about 45 to 60 minute webinars covering a lot of different topics. And we've got some really short 3 to 5 minute videos covering each of the basic aspects of this website and showing you what it's capable of, how to use it, how to get the most out of it, and kind of some best practices there. So definitely check those out. Spend 10-15 minutes, get a better understanding of GuruFocus, realize its power for you, and we think you will be extremely happy with the site and with the tools that Charlie's built for all of us. So thank you again for attending. We hope you have a wonderful rest of the week, and we'll see you on the next webinar.